Hi, welcome to my channel where we provide an alternative view to the common narrative. Today I'm going to talk about the financial markets or the financial position of the American economy. As you know, Fitch has downgraded the status of American debt, and just recently, I think it was this week, Moody even downgraded the debt of America with the aim on funding two wars and running a huge deficit. And there are rumors that about the deficit for this year would be about $2 trillion. And the interest payment on this debt, of the total debt of the US, will reach about $1 trillion of interest payments. Now that's a huge amount, about 8% of GDP. And it's very difficult for any country to sustain this type of debt load. And it doesn't seem to me that the American lawmakers or government is going to cut back on spending. In fact, interest rates are rising, and they're running this huge deficit of $2 trillion at a much higher rate. And they are planning to borrow about $700 billion this quarter and $800 billion next quarter. Now, I'm not an economist, so it's sometimes very difficult to interpret all the information that I read. So I got a nice article that was talking about the US Treasury market, and generally it is considered as very liquid. And because of its huge market and the liquidity of it, it is always a safe bet to invest in American treasuries. But it seems to me that is not always true, and things are changing drastically. Because of the world is going into a de-dollarization phase, and the new world order is going to be moving away from the dollar itself as a trading or as a reserve currency. It will still take some time. Nothing happens overnight. But this article was quite nice or interesting. I had to read it a couple of times to fully understand it. So if I still make a mistake, please don't hold it against me. As I've stated many times in my previous videos, America needs to be an hegemon on the world. It needs to control the world per se in terms of financial markets, and the financial markets and the dollar, and the dollar is basically enforced on the world, and it's supported by American military might. And that's why we had the petrodollar, which was enforced, where all oil had to be sold in dollars. But that period has now come to an end, because we know that Saudi Arabia does sell now oil in yuan, and the Russians are selling it in rubles. And there's also other countries that are slowly going into the local currency exchange. Now, the whole matter started in 1986. When America started to run a deficit under Ronald Reagan, and everybody was wondering how they're going to finance it. But luckily, the rest of the world, because of the petrodollar and for the belief in the American economy, and the dollar was a world reserve currency, they bought about from 1968 to about 2002, the foreigners bought up the treasuries. And the way that it happened, basically, they would export goods to America. America will buy them and pay them in dollars, and then they would recycle the dollars into American treasuries, and they would keep those treasuries basically then as a security and as an investment and as a reserve funds, basically in their reserve banks. And at that stage, about between 28 and 30% of the treasuries were bought by foreign countries. But from 2002 till about 2014, Chinese had a big expansion and what became a big buyer of U.S. Treasuries, and the percentage of foreign purchase of the U.S. Treasuries reached up to about 50%. Now, we all know about the financial crisis in 2008. And after 2008, the Americans started to the quantitative easing. And quantitative easing became nothing more than a money printing operation. And I've explained usually many times before that when you print money, you are supposed to devalue your currency. And when you're devaluing, you are increasing the inflation rate. But because the Americans were the hegemony and they controlled the global reserve currency, that inflation was usually exported to other countries in terms of that the exchange rate between the US dollar and theirs would then deteriorate in proportion to what the supposed inflation would have been in America. So the Americans never experienced them. They could go on with their lavish lifestyles. The example I usually use in my previous videos that in South Africa the minimum wage is 22 Rand. In America it is $12. Now doing the normal conversion, $12 is about 240 Rand. So our minimum wage is about 10% of what the American minimum wage is. So I'm not sure how you can stay competitive with any exports if your wages are like 10 times more than the places you want to export to. But in any case, so in 2009 when America started with their quantitative easing, about 4 days later the financial minister of China brought out a paper, and the paper was basically called, what was it said? Basically, it promoted the story that the world has to go off from the US dollar as a reserve currency, that the world trading should be de-dollarized, because they knew that was basically inflation. But things never move in a very fast way, especially in the financial system. And by about 2014, that is when China stopped buying U.S. Treasuries. And subsequently, constantly, the foreign buyers of U.S. Treasuries have decreased percentage-wise year on year. Now, we had several crises on the in the U.S. Treasury market. There was one, let me just see. 2014, 2019, and then in March 2022. And then the Euro gilt market breaking in the fall of 2022. And that created sort of a shockwave through the Treasury market. And we all remember also the effect of the COVID, and during that period America printed like $7 trillion. Now all these things are extra debt, and that spooked the markets and created a different effect, and that is the interest rates started to rise, inflation started to rise, which was basically driven by the COVID era. And then we had sanctions against Russia, and that even drove up the interest rate. And when interest rates go high, and then the bond market or the yield increases, but the yield decreases of bonds. So they are less valuable than what they are. So basically what you do is you say you buy a 10-year treasury at, say, 1% interest. But now the interest goes up to 2%, but you paid like $100 for that. But now the value that you can exchange the piece of paper later on over 10 years is that you're going to get your $100 plus 1% for the next 10 years, where you should have gotten 2% for that. So basically you lost money. And that is what actually caused the problem with the Silicon Valley banking crisis. Now, with the Silicon banking crisis, what actually happened is that because the foreign buyers of treasuries became less and less and less, at the same time, the US forced the banks to be, because of the 2008 problem, they forced them to have more assets, and in order to ensure their liquidity and the stableness, and that means they had to keep more assets in their reserves, and naturally these assets were US treasuries. And effectively what has happened is that the local banks in America have become the buyers of treasuries as a replacement for the foreign buyers that usually bought the treasuries. So basically they forced the local banks to buy the American debt. Now again, at that stage it was all fine and there's nothing funny about that. The interest rates were very low. You remember, it was like 0.5% or 0% or very low in any case. 2% or no, yeah. I can't remember the numbers. So everything was fine and so on. But then we had the bank run on Silicon Valley Bank, and for some other, the economy started to decrease. The sales were not up. People withdrew some of their money, their savings, in order to finance their expenditures. And because of that, we had sort of a so-called run on the banks, which wasn't really a run on the banks. It was a question of they're using the reserves, so they needed cash, and they withdrew the cash out of Silicon Bank. Now, Silicon Bank has invested in treasuries and stuff like that. And as an example, they would have, say, paid $100 for a treasury, giving over 10 years or 2 years or 5 years, whatever, for at a percentage of one interest. But when they bought, that's when they bought it. But at that time, because of the interest rates that have increased enormously, once the yields were actually up to 5% on a treasury, the 100 treasuries priced at $100 were not selling at $100, but they were selling at $70. And because the bank needed cash and so on, they sold their treasuries at a loss of $30. And that created financial problem, and that finally created the bank problem, and for Silicon Valley Bank, and also happened to several other banks. Well, then the American government jumped in and sort of bailed them out again. And what they have done is they said to them, okay, for 1 year, the scheme is supposed to be for 1 year, you can exchange your treasuries and as an asset, and then you can borrow money against that asset. But the problem is, the treasury piece of paper was bought at $100, but the current selling value was at $70. But the Reserve Bank said, no, don't, Reserve Bank Treasury, US Treasury, I don't know, I always get confused between them. Said, no, you can take the paper value of this treasury, $100, and you can borrow $100 against that asset. Now that is wrong. You are supposed, the value of that treasury is $70 because that is what you can sell it for. So you're supposed to only be $70 can lend against that asset. Typical like what you do with anything else, but that is unfortunately the trick that the US Treasury or the Reserve Bank did of America. And that solved basically the liquidity, or the loss in the treasury was actually transferred from the banks to the US Treasury, and they were accumulating all those negative call it losses of the treasury. And this was supposed to be only for 1 year, and that saved so-called the banks. But the problem is it didn't solve the problem really. Well, this didn't solve the problem, it only transferred the problem and kicked the can down the line. Because according to this article, and I don't fully understand it, but it says if you look a little bit deeper on it, the whole method becomes a control of the yield curve. Basically, They were controlling the amount of profit you could make on the treasury. And at that stage, it was less than what you could normally have made. So if you could have made, say, 5%, this mechanism allows you only to make 4%. Now, according to that, what he says now, this type of control yield curve is a place where financial markets come to die, the free market. So it becomes a whole totally controlled type of financial markets. And we've been knowing that for a long time, especially when we get to the shares in America and the Dow Jones and so forth. It's all non-market related. There is no more capability of determining prices of any shares and so on. It's all like artificially. And this is the same now happening with the US Treasury. But if you really look at it a little bit further on this, the fact that you had to there's no more foreign buyers of treasuries. There is basically, you cannot get rid of your dollars because you have, it's lower price than what you bought it for. So if you sell it at a loss. And who wants to really sell it until you're in a big problem? So, and who wants to buy it in any case? So there's a liquidity crunch on the treasuries, which is not supposed to happen because the American treasury market is supposed to be the most liquid in the world. So that's a fallacy as well, as we can see. And with this type of mechanism, they are already arguing that it's not going to be for 1 year, but it's going to be extended permanently. And when it becomes extended permanently, then the control of the yield curve is permanently, and this whole farce goes forward, and the losses that the Treasury is accumulating is going to increase exponentially. And so basically what they argue is that the US Treasury will become the buyer of last resort of US national debt. Now, Japan has done it itself for the last 10 years. Their Japanese Reserve Bank is buying their own government debt, so all the debt is kept in circle. It's like you lend yourself, you print money, and then you lend that printed money to yourself for you to expend. So you're creating your own wealth out of thin air. That is basically what you are doing. And there's no way around it unless you can sell that debt, but nobody wants your debt because you are creating your own money. Now, we as private persons will never be allowed to do it, but it seems to me that the Americans have found a way to crook the market. So the basic point of this whole matter is that the world is moving away from the US dollar. Treasuries are not that liquid as they're supposed to be. The two rating agencies have already downgraded the US Treasury market. The American banks are still being refinanced or quantitative ease all by this buyback mechanism from the US Treasury. The US Treasury is gathering more and more debt. And it still doesn't renew some of the debt, but it puts a strain then on the economy and those banks and so on to repay those loans. So it doesn't look so well, contrary to what we hear every day. And as I mentioned in one of my previous videos, I talked about this, said when they asked Janet Yellen, can America afford fighting or supporting two wars in Ukraine? And she said, yes, no problem. American economy is very going, in spite of that tax collection has decreased by 9%. Now, if you get less taxes in than last year, then there's something wrong. Then you can't state your economy is growing, because in a growing economy, there is more development, more sales, more salaries, more unemployment, which is more salaries, which then translate into a higher tax income. But that is not what Janet Yellen said. The tax return decreased by 9%. It's nearly 10% less taxes that you are collecting. So please, somebody explain it to me how that works, because I don't understand that. So my company is growing and etc., and I have more turnover, but I pay less taxes. That's unless you have some how you call accounting tricks that you employ and allocate funds to various, or you export your profits to a non-taxable income and so on, then I can understand that. But on basic, simple accounting practices, that shouldn't be possible. But we also know that the American guys have been lying for the economy now for how long? And which I don't understand is why people don't see it. But if you listen to some of the experts like shadow statistics and so on, the unemployment is not low. The unemployment is very high. But the Americans, the figures that they make available are usually some thumb sucked, because a lot of those numbers are estimated. They are not counted. So the unemployment numbers that you hear are not counted employment numbers. Those are estimated to some or other formula that constantly changes. And if the world, and if you do trade sanctions that do against various companies, then your companies sell less product. So your exports are less. So your balance of payment is different. And if your foreigners that don't buy your debt, then who's going to buy it then? And so all these things doesn't gel, in my opinion. It doesn't make sense that people claim that the American economy is so strong and it's so robust and unemployment is so low. But on the other hand, you can look at that, people that look for work. You see all the immigrants that are looking for work. I don't know. Like I said, I'm not an economist. I'm not a financial person. But for me, 1 + 1 is supposed to be 2, but they tell me no, it's 3. So you can leave a comment below the video, because I would like to myself to know. Any case, that's my story for today. So until next time, cheers.